if you understand that everything in the world's global economy works off of the benchmark risk-free rate, which is the rate at which the Treasury pays its interest. If that changes, everything changes. Our entire financial system changes. To drag this out and make this an event is not the right way to deal with the fiscal recklessness of the past 50 years or 40 years since this bond market started its bull market. Please make sure that you're updated on what's going on, because as we approach that date, if there is no solution, then this becomes a real issue. If there is a solution, then I think that what you'll see is this becoming the main event for the presidential election in 2024.
Welcome to another RTD interview. Today, I'm excited to have returning guest, Mr. Lior Gantz, the founder of the Wealth Research Group. And today he's joining us to give us his thoughts on the macroeconomy, local economy, as well as possible investment opportunities. So I like to check in with Lior every few weeks just to see what he has his eyes on these days, because he's well connected and very informed as to what's happening on the macro picture. So Lior, welcome back to RTD Interviews.
Thank you for having me back.
Lior, as I mentioned before we went live, excited to just connect with you as always, man. I appreciate you for making time for me on such short notice, but you do a good job of breaking things down to the bare bones of things. And also as an investor, you definitely give us different things to keep our eyes on as well. So looking forward to getting your thoughts. So at this current moment, with all the things happening, we're going to get through them all. But what's most pressing, what's most of concern to you right now that our viewers should definitely be paying attention to?
Look, there are two major events that are happening in the economy. First of all is what's called the X date, or the date at which the Treasury will run out of cash if they don't raise the debt ceiling. That's according to estimates right now, it's June 6th. So as we do this interview on the 17th of May, this is top of mind. And actually, just to give you an idea how top of mind, Jamie Dimon, CEO of JP Morgan Chase, has opened a war room in the event that the U.S. does do a partial default or anything that is unprecedented. Jerome Powell in his last FOMC meeting said, "If I don't know what I would do if that would happen." He said, "This has never happened, and it will basically change the whole world." And Warren Buffett said that in the Berkshire annual meeting that he didn't even want to discuss it. He was like, they should just raise it. And I know that a lot of people are like, no, they should definitely not raise it. Like, we're mortgaging our kids, and don't people care about debt? They do. Everyone does. But we're already here. And if you understand that everything in the world's global economy works off of the benchmark risk-free rate, which is the rate at which the Treasury pays its interest. If that changes, everything changes. Our entire financial system changes. So to drag this out and make this an event is not the right way to deal with the fiscal recklessness of the past 50 years or 40 years since this bond market started its bull market. So my big thought here is that please make sure that you're updated on what's going on, because as we approach that date, if there is no solution, then this becomes a real issue. If there is a solution, then I think that what you'll see is this becoming the main event for the presidential election in 2024. Because I have, if you haven't downloaded my portfolio, just do. Look at my portfolio. You might find some things that you like in there. Just go to wealthresearchgroup.com/portfolio and download it and use it as a reference point. The reason I bring it up is because I just listened to about 30 quarterly earnings calls out of the 50 companies that are on that special report, and most of them have done really well to address this new regime of interest rates. It seems like the only entity that is still doing the same as it did in the ZERP era is Washington. And I think that is going to change. We've already seen riots for months in France because they've raised the retirement age from 62 to 64. And I think that you will see around the world much more austerity measures and cutting back with regards to governments in the next few years because this is going to become the biggest topic for most developed countries. Unsustainable debt and how do we restructure it? I think that's the big one that's coming in the next few years. So debt ceiling X date is one. Second is what I call the regional banking contagion or lack thereof. So in the United States, there are about 4,000 banks. We've had a few bank runs and bank failures and seizures and takeovers, etc. But for the most part, this has not become a 2008 issue yet. And so the big issue here is whether or not within those 4,000 banks that are active and hold deposits of both individuals, corporations, and everything in between, are there more issues? Are there big issues? And I think that we still need more clarity on how solvent these banks are. The problem that they face is what's called a mismatch. And a mismatch is the fact that when depositors put their money into a bank, the bank then tries to either loan out those funds, and if it has an issue with loaning, which banks do right now, they're very afraid of loaning, then what they do is they go and instead of loaning out to mortgages or to corporations, they simply buy bonds, government bonds, that is. But if they buy bonds that are very long duration, and on the flip side, they have a lot of depositors that are looking to cash out and move to money market accounts, then they can suffer losses on those bonds in order to pay those depositors. And when that happens, which is exactly what happened with Silicon Valley and with First Republic, you have an issue. So there is a problem brewing with many other banks, and it's still the jury's out on whether or not this becomes a real issue or not. So I think those two things are critical, and we'll know more in the weeks ahead on how they get resolved.
Right. Now, you mentioned the debt ceiling. So I want to definitely stick on there because from my angle here and what I'm hearing is so much panic out here globally now. This doesn't feel like your typical, debt debacle that we have every couple years that, typically is until the last minute something is passed through. It feels as if this one might be different. And so just play out two different scenarios. If the government decides to miss that final deadline and there is some defaults or whatever capacity, what will be the response from the world as well as to the dollar? And then based upon the fact that there are not a lot of countries are nervous, full faith and credit is already being questioned as to whether or not they can trust the government continue to, be able to come to agreement on things. So with those two scenarios there, one is extreme, one is the fact they're flirting with it still. What are some possible scenarios that we can expect, in your opinion?
Yeah. Well, first of all, they can default without actually defaulting. So instead of not paying interest rates or interest payments to creditors, they can push off other items that are internal. In other words, they can push off Social Security and Medicare and Medicaid and default against obligations within instead of without. That's one option. I'm sure that there are more provisions in there where they can essentially prolong this without actually defaulting. But a full-on default, in other words, the United States not paying its obligation. A recent survey that was published with hundreds of participants showed that half of them would buy gold. So I think that if you have a default or any glimpse of a default, then you could see a spike in the price of gold. You could see gold rising by $100, $150 a day for a couple of days straight. But I give that a less than a 1% chance of happening. what's more likely is that Republicans, who certainly as a political party, are more inclined to show voters that they are fiscally responsible, are going to use this as leverage in negotiation and perhaps even toy with the deadline. But the agenda would be to show voters that, hey, if you pick us, if you vote for us in the coming election, we will make sure that this doesn't go on to perpetuity. We will come down with solutions on how to um, cut back on spending, et cetera, et cetera. So I think that that's more likely, far more likely, that that's what you're going to see. Still, if you look at what's called credit default swaps, in other words, institutions that take their dollar debt and sell it and get in return euro debt, and basically swap debt with the euro countries, that's at an all-time high, and that's basically a derivative on how panicked institutions are that something may happen. Now, something that is likely to happen is a credit rating downgrade, where the United States is no longer considered risk-free if so much internal division persists, even to the point where politicians allow themselves to toy with something as um, as important as the risk-free um, benchmark for the rest of the global economy. So I think that in and of itself is a real issue. If Moody's or S&P Global or any of the big rating agencies decide to downgrade credit again for the United States, that's going to be atrocious in and of itself.
Now, you mentioned that gold. And so gold last couple of weeks, due to the banking debacle that's underway, I'll definitely get your thoughts on that. The whole regional bank contagion, it seems to be something that is on the mind of a lot of investors here as they're pulling their funds and funneling them up to the globally systemic important banks. But gold is the centerpiece of all this, I think, because as a result of all this concern and panic, it's reached above 2,000. And as I think, I'm not sure today, but yesterday it got below 2,000. What are your thoughts on gold? You mentioned earlier if they did default, we can see price spikes of $100 plus, a day type of event. Where is gold at this current moment, and how valuable is it in your opinion?
Well, like I said, I give it a 1% chance of happening. So I don't think that gold has much upside from here. In other words, in the short term, first of all, you have very contained regional banking crisis, and the regional banking crisis did push gold prices above 2,000. Then you have this X date, which I believe will happen. We'll get to that date and we'll see the debt ceiling raised. So that's another catalyst that goes away. Between those two catalysts, those are huge parts of why gold brushed with its all-time high just a few days ago. So I think that if those two events come and go, and after reviewing 30 earnings calls and understanding that companies have done amazingly well to change their business structure and to stay profitable at these very, very high interest rate environments, I think that the Fed is going to allow itself to stay more hawkish. And that is not good for gold. So I think that gold could be in no man's land for a few months more if we do get a soft landing scenario. So that's my opinion on gold. I think that it could stay below 2,000, and only when the Fed actually starts cutting rates, and that could be November or December, will you see gold rallying again.
Do you see the Fed continuing to, another quarter point, another type of activity in the next meeting in June, or what are your thoughts? Are they done, or are they going to pause, or what are you seeing?
Initially, it was speculated that that's it, that the May meeting was the last rate hike. But the bonds futures, which are always open on my browser, and if it's not on your browser, then just Google CME Fed Watch Tool, and that's basically bonds probabilities 2 years out. Then you can see that not only do bond traders think that there could be one more rate hike in June, but what's more interesting is that the interest rates that they forecast for end of year, in other words, for the December 15th meeting, is 4.5% to 4.75. So even if you think the rate cuts are coming, we're not talking anything meaningful. Interest rates at 4.50 at the end of the year basically mean higher for longer. And that also assumes that no recession, because if in a recession, they'll cut more aggressively. So right now, it's a weird paradox where everyone's talking about recession, but at the same time, money talks and money says no recession. So it's a real interesting time, and we shall see what's happening. What I do think is very interesting about these times, before we come to a close here, is that this recession or this reset is impacting the rich far more than it's impacting the working class. You're not seeing very high unemployment. This is not a classical recession. This is a recession of interest rate sensitive industries, and that's for the most part equities, real estate, and anything that actually the wealthy own. And if you see layoffs in big tech, those are layoffs in high-paying jobs, and these are all people whose stock compensation and options compensation has gone to zero. So I find that really interesting, that the paper economy has been hurt way more than the real economy.
Last question here. Opportunities. Based upon what you're seeing, where are the opportunities? Where can people begin to do more investigative work for themselves, just to consider some possibilities and opportunities to take advantage of all this uncertainty and things of that nature, in your opinion?
Yeah, I think for now, people should look at either money market accounts, which pay 5, 6, 7%, depending on what you find out there, debt funds that pay 10 to 12%, and just stay very opportunistic, because if you can get 10 to 12% fixed income, you don't need anything else.
Sounds good there. So, Lior, as always, it's great to connect with you. Thank you for joining me on such short notice to share your thoughts, and definitely, give us more optimistic viewpoint on what's happening now, as well as giving the viewers a chance to just plug into your world and see what's going on by looking at your portfolio directly. So for those who may not know who Lior is and might come across this interview for the first time, give them a little background and point them to where they can find out more about you.
wealthresearchgroup.com. Just sign up for the free newsletter. That's the best way to stay in touch with us 3 times a week.
All right, sounds good. Thanks again, Lior, for joining us on RTD Interviews.
Thank you.